All right, ladies and gentlemen, I hope you guys had a wonderful weekend and holiday. I want to leave you with some dividends for the weekend, and we're going to talk about how much money do you need to get started. And this has been coming up a lot. You guys could check out the other dividend video I made. I'll put that here in the description. And also check out that first link, you guys, youtube.com/the stock market. We are trading live every day, well, Monday through Friday, 30 minutes before open. And I want to start incorporating the dividends. I'm going to show you guys even, the approach with some of this stuff and where to start. We started this out as, we was getting ready to make some dividend plays, but we did the contrary. And it's a good point to highlight, really, dividend versus growth. But the thing I want to talk about here is how much do you need to start? I always recommend everybody, the young guys call in when we do the 11 at 11. I'm just saying, get some stocks, and I really want to put you guys onto this stuff so you could start getting it. But I think a common fallacy is that you need a lot of money. It's no, you just need a lot of time for dividend investing. That's it. And now there is ways to maximize it that it's going to either take you a lot more time to see a big return or something that you want, or it'll take a lot less time. Nonetheless, though, the key there is, what type of return when it comes to dividend investing and any long-term investing, this is the finish line you need to set. It's not about who gets to the finish line first. It is actually making it there and deciding, okay, this is how much I want out of, I'm tying up this much money. What am I looking to get out of it? That is your investment goals, my friend. So let's get into it. I have a little list of some highlights I want to talk about with you. Make sure you guys drop a like if you think this is helpful, and let me know what other dividend stocks you guys are looking at, because I have examples here. But right off the bat, again, this is kind of starting off in the beginning. So watch that video. I went into full depth with it, but don't focus on the yield as much as the context. So there's going to be either equity growth in a stock, and some of them will be, bigger movers, or they're going to have other features that make them more appealable, whether it's, it holds its value. But again, another thing is that I spelt that wrong. But another big factor of all of this is factors like, do they raise their dividends? And even for some companies, again, because if the yield is too high, and I'll make another video talking about some of the key terms to follow along with the dividend stocks, but some stocks may not be able to pay their dividend. And you guys have to understand, again, this is coming back to the background. Why do companies pay dividends? And, why don't they pay dividends is a better question too, is that some companies are newer, they're starting out, and quite frankly, they don't see it as a good use of profits to give money back to shareholders when they could be reinvesting and putting their money into better endeavors that will hopefully bring in a larger return in the long run for investors and everybody else involved. And this is even what happened. So you guys even know this account we had, it was at 29,000. I think it started with 27 or even 25 before that. But it went up to 28,900, and today it's down 1,600. And why? It's not like they made, I had the people in the real estate office, I'm helping with this. I'm trying to see what they're doing. But, it's not like they made any crazy trades that they got the loss from. The biggest thing that it came from is right here. It's from the real shares. They got these on the IPO. They spent about $29. Remember, I cut out of it, but they held it, but they bought 500 shares. So 500 shares down from $29. It's like $3 a share. There's literally your $1,500 loss right there. So even just holding this stock, you're seeing, taking L on it. And, they did buy a decent amount of money, and you have to start thinking, percentage wise. See, it's around 50% of the portfolio, $13,000 of the 20 something in there. And again, it had a higher value, but you seeing the average price, how many shares, this is what, this is a different approach and strategy. Damn, there's 2,000 people who hold this. Geez, so I guess we're not the only cucks. But again, I wanted to, this is the outline I've been giving them to make these trades, because I want to see how they go about it. They saw the IPO. And again, this goes to the biggest thing we're focusing on. There's going to be some stocks with equity, some stocks with dividends, and some stocks that have dividends. And now some are going to have more of an equity opportunity. So that didn't have dividends at all. And you guys could see you're taking the risk. And now this is the whole point with okay, well, why wouldn't you just buy stocks without dividends? They could go up, and we could talk about that. But at the end of the day here, when this starts to go down, and if it goes lower and lower, it gets pretty bad. Any money that goes down in value, you're losing in value if you decide to sell out, or you have to hold it till it goes up. But the key with the dividends, it's going to allow you to get in some of these positions, but you never sell. Because even month after month, you will start making money. And what does that do? It's going to lower your average cost if the company's paying you money to hold. So watch out for that, but focus on the factors in the videos, understand the difference with the high yields and not. But now, how much to really start with? this is what you have to ask yourself. What do you want from it? And that is going to go now, do you want stability or do you want growth or do you want a mix of both? And that is a big thing you need to figure out. And the next thing I followed up with is, how old are you? If you're younger, you could go for more of the equity gains with the dividend. If you're older, I would be looking for something more stable. Again, why? If you guys have, anything financially related, the point is, if you're making an investment and you're older, you are going to have less time. And at the end of the day too, being older, your income is going to be, or your expenses are more or less going to be fixed. You know what it takes to live and what you're going to need. So then again, this is how people use this stuff. You're younger, you could take a little bit more risk and you have time to see it come to fruition over a longer period of time. Whereas if you're older, you're coming near retirement, you can't really wait that long. So I have examples already set up. I have a few different companies. Again, these ones we didn't talk about in the last video. So I want to share with you some stocks that fit this criteria for both sides so you could get an idea. But the point is, you could do what you want when it comes to dividends. It's not as if dividends have to be boring and they have to be these slow movers. No, you could go for the bigger gains. You could go for stuff that is paying high yield, has growth potential, and even then a lot of stuff like Abivai, and I don't know if Eli Lilly, but Abivai, that they had a pretty high paying dividend. They'll get bought out. So imagine you're catching a dividend and it gets bought out. I mean, that's just a win-win. But, so there's exciting plays you could park your money into, and it's not like it has to be this boring thing. But at the same time, why did we only have equity here in Real? Because, other dividend stocks, it's not, I don't really believe in buying them arbitrarily. Once you kind of have your strategy set up, you can. But for me, what am I doing? You could see what my strategy is. Why wouldn't I just be buying anything now? I already have a big dividend portfolio. What I'm trying to do here is find that mix between stuff that could get me good equity gain and a good dividend. So some things at certain prices aren't really the business yet. But once you figure out what you're wanting, this is going to allow you to decide, in the grand scope of things, how much money are you going to need and how much money is wise to even put in. But the next thing you got to focus on to figure out how much to really start investing with, it all depends on the amount, but you're either going to focus on 3 stocks or pick a small concentrated group, or you're going to get a basket of them. And now this could either be an ETF or literally picking multiple companies, but now this depends on the amount. This is my opinion on it. And if you ran tests, this is just to let time work a little bit better for you. It does become a little bit more difficult. And again, this is a $30,000 account roughly. People say, okay, you need a decent amount, but that all depends on the strategy. And it's ironic because I told this to them. They didn't really listen as much because there's 13,000 in there. But the whole point I would say is if you have 10,000 or less, I would focus on top 3. Now, even though I'm saying 10,000, that amount is really arbitrary because anything 10,000 to 1,000, I'm pretty much viewing exactly the same when it comes to dividend stocks. I know it may sound weird, but what I'm saying with that is if you're using less than 10,000, I would focus in on a core group of companies so that you can maximize your time for return so that you're not spread out all over the place with, $50 here, in 10 different companies or 20 different companies, whatever it may be. You're better off, even if you had $1,000, $300 into 3 companies or $500 into 2 companies, it's going to give you more bang for your buck and let you, at least take advantage of it. You do run the risk of you pick the wrong 2 companies, this and that, you don't have diversification in there as much. However, the smaller amount, you could take that risk. Diversification is used for larger amounts. Now, if you have above 10,000, then you could start getting a basket. But again, the more money, the more inclined you should be to diversify. The less amount of money, try to focus in on a few, and that's just to make sure you get the most out of the time. Now, tell me if you guys agree or disagree with this if you have a dividend portfolio, because some people agree with this, some people don't, and that's where you guys get to see. It's all personal preference at that, but it circles back to what are your goals with these investments. And lastly, before I get to the plays to show you guys, the starting amount isn't as important as how much you're going to add to it. So having an amount and starting and doing whatever investments, that's great. Even if you are starting with $1,000, it doesn't matter how little you start as long as you make a plan. And I'm going to make another video showing you that I've been doing that with a different account with a different approach. But as long as you're consistently adding to it with dividends, that's the power of compounding. That's when it gets really good. So even if you only have 1,000, if you figure out a way to deposit $50, $100 a month, you treat it like a savings account. That's why I tell all of you guys, hey, it doesn't matter how much money you're touching, just start setting up savings, and then you could trade some options on the side with it. But even if you want to trade options full-time, whatever, get some money working for you and diversify in that sense. But the key plan is setting up a plan of savings and treating this as such, because that is where it's going to, you're able to get more money. You could either buy more plays or diversify after a certain point. But the more money you get in there sitting over a longer amount of time, that's why the younger you are, the better. You just set out a small amount that you wouldn't even notice. It could really, really add up and do some work with you, and you park that money in there. And again, you're parking it in the right place. A lot of people, from Robert Kiyosaki down to Tony Robbins, especially Tony Robbins, they'll say that's the way you get rich. If you just buy dividend stocks, don't sell, you give it time, you're golden. So keep that in mind and try to do that. So now let's talk about some plays that I have for you. And these are a mix of both growth and good yielding stocks. So one of them I like, because this one might surprise people, Amgen. This is a pharmaceutical company. So surprisingly, they pay 3%, but now think about it. Pharma, there's going to be a lot of risk. So tell me, is this going to be for younger or older people who want growth or stability? Even though it looks pretty good over the last few years, this is definitely a growth stock. But this is where I'm saying you guys could see some of these moves on a lot of these companies. And again, that was just overall the market as well. But these are some pretty awesome moves. That's still 400 or 500%, almost 100%, even from 2014. And that isn't too long ago. And that's the crazy part. Some of you have been watching me since 2014 or 2015. You could have been collecting, quarter after quarter of dividends and the equity gain. It could be pretty good. But Amgen has some growth. It has a nice yield, 3%, and that's going to get reflected there. But again, you're taking certain risks. You will also be able to get equity gain, but also the risk. And, think about why a stock like Amgen would be paying out a dividend, though. It is more of a solidified biotech is what you could say. Another one here, NetApp. Again, so technology related, and you could take a look at this just right off the chart. It's held there like a dividend stock for most of the years, and it's popped, and now you're getting volatility. But this is another one, you're getting a 3% yield, but it has more volatility. You can see 12-month performance is down 20%, but over 1 month, it went up 1%, 6 months, 3%, plus an additional 3% on the yield. Not too bad. But it's going to have more volatility, but that could also lead to either more growth or more risk on that end. Another one, I like this one, and I think this one is probably my favorite. I don't have a sizable portion in this as a dividend stock, but I might want to get some. AT&T, and simply, I don't like it because they did remove AT&T from the S&P 500 at one point, or the Dow, I believe. It's not as what it used to be, and it's telecommunications. There's a lot of competition, but again, too, it's not going to be really growth. AT&T, think about it. You guys already have AT&T. It's competing with Verizon. If anything, they're so everywhere that they have more to lose than more to gain with growth. However, this could be a 5G play, and that could give it a lot more upside. But right off the bat, it's a 6% dividend yield. But again, that's kind of scary, and you see it's at a lower equity price than 2012. But again, that 5G element could add some growth to it. It could have some growth, but looking at this, it's more stable. And like I said, AT&T has more to lose. It's not really going to go anywhere. But even on the 20-year, you see this stock, you see what it was at 01, and the last telecom boom, it came down. So it already has shut off a lot of its value, and that's what makes sense. The dividend has always stayed high. They've consistently paid the dividend. Think about one of those factors. AT&T is always going to have money to pay out a dividend. If not, we would have a lot of things to worry about, I'd say. But for the most part, they're pretty solid, and as you can see, it's stable. This isn't going to be one that's going to give you equity growth, but a high dividend yield. You're going to get, if anything, more likely to get a raised dividend than a cut dividend. You're getting it at a discount even in the last 2 or 3 years. I like it, in that sense. It's not too bad. Next one, again, this kind of falls in line, and you'll see some of these, this gets a little bit more volatile. It's held up because it's made big moves. It used to hold up and kind of hold its ground. You guys all know 3M. Think about how many times, Post-it notes to just random trinkets and whatever it may be. A lot of you use 3M products, Bic lighters. They're going to have a pretty solid foundation. They're a good company. They're not going anywhere. 3% yield. However, it's really, really gone up recently. And some of the other value stocks have done this. So there's going to be more volatility, more downside. But again, the fact is this floor might be lower. It may not have to come down here. But even if it does, these are the ones I start to like because now you're seeing the growth potential, but it's expensive now. And then this is why I'm also saying with my approach, I'm finding some of these stocks. I want good dividend stocks that are going to come down in value, hopefully have a negative 12-month performance to be able to, again, that's what's going to even raise the yields even more. Price goes down, but their yields stay the same. But 3M did have negative guidance and some other things. Another good one to look at, McDonald's. And now this one is definitely in that growth, value stock. It wasn't always the case until recently, but then it makes sense. It went from China, it went from McDonald's being domestic and, even going all over the world. But then as they started getting more growth in China and then overseas and, all day breakfast, those changes didn't come till later, believe it or not. But they've had an epic run. This is a dividend stock. It's a great dividend stock. You guys know we love it, but it's a lower yield. And that is going to happen, especially as the price increases, because it is pushing more towards growth. So this is going to be more riskier and, again, less stable. But I want you guys to have different ideas, and you guys could see some of these stocks. I don't think they're as boring, because this is just tipping the iceberg. You guys could get in a really risky stock, because these are all names but I'm trying to give you a good starting ground. But you could also see the potential. It's not like in the last 5 years or so, even 10, that these stocks didn't move a lot, even some in the last year, especially if you got them at good prices. But another one, Clorox, 2% yield. This one is more stable. This one isn't going to be growth, even though it looks like it has grown a lot. I think it's just moving with the market, but I think I would try to get this at a lower price, because I think it's kind of high there. But I wouldn't be playing this one for growth. And lastly, we got Polaris. Now, this is an interesting one. Again, more growth stocks here. I haven't given you too many stable ones. I think only like AT&T. I mean, you guys can't pull up Walmart if you want. I think that one could be a good one too. See, but it's a low. There's another stable one. And again, but they do have growth opportunities with stuff like e-commerce, which I think is great for them, but also competition. But back to Polaris, it's like almost a 3% yield, but I like this one because of the growth. At one point, it did grow a lot. It's kind of weird to see it fall off. I mean, people buy these little toys and snowmobiles and whatever it may be, but this is a decent company. They've been around for a long time, but whenever it starts to kind of come down, you got to realize you get both growth with this one as well as a certain level of stability. So that's why if you do find it at the right price or how you even scale and average into it, it could be pretty good. But hopefully, this gives you guys a bunch of ideas. Let me know what you think. Let me know what your dividend portfolio's at, what you started with, all that. How many of you are still interested in these dividends? But hope you guys have a good weekend. Drop your like, subscribe, and I'll see you in the morning on Monday in the watch list. Let's go!